You're earning more than ever. The promotions are happening, the math looks right on paper, but you still have that nagging feeling that you aren't building real wealth. The truth is, as your net worth grows, you face invisible traps. They don't look like disasters, they look like normal life and feel like progress. Today, we're breaking down these 7 traps and exactly how to avoid them on your path to building generational wealth.
When your income rises, your brain redefines normal. You upgrade the apartment or the car, and slowly these upgrades become part of your identity. Once that happens, cutting back feels like self-betrayal. The numbers are staggering. Roughly 40% of Americans earning over $500,000 a year are still living paycheck to paycheck because their fixed costs expanded to consume their massive income. The fix? Scale your savings before your lifestyle. If you get a raise, try to maintain your current lifestyle for 24 months. For a massive promotion, wait 12 months before any upgrades. Use the 75-15-10 plan. Live on 75% of your income, invest 15%, and save 10%. In a roaring bull market, early lucky investments are often recorded in your brain as skill. This is a cognitive bias called the illusion of control. This fuels overconcentration, holding way too much wealth in a single asset. History is full of warnings. Look at Intel. In the year 2000, it hit highs it still hasn't recovered from decades later. The fix? Most experts warn that no single stock should exceed 5 to 10% of your total portfolio. Don't let early success push you into day trading or heavy margin debt. For high earners, taxes are the single largest expense in your lifetime, larger than housing or food. Yet most people spend more time optimizing Netflix than tax strategies. Holding high dividend stocks in taxable accounts instead of Roth IRAs creates a constant wealth leak through annual taxes. You also risk the trap of financial complexity, layering advisors and private investments just because it feels sophisticated, which creates blind spots and hidden fees. The fix? Keep investments simple. Utilize tax loss harvesting and understand the difference between short-term and long-term capital gains. For those with a net worth between $1 million and $2 million, 66% of that wealth is typically tied up in a primary home and retirement accounts. This makes you dangerously illiquid. You can't liquidate a house in a week to access cash for an emergency or a great opportunity. This is often fueled by buying the biggest house the bank approves. But remember, bank approval isn't financial advice. The fix? Total housing costs, including maintenance and insurance, shouldn't exceed 28 to 30% of your income. As you get wealthier, you become the person loved ones go to for capital. The harsh reality? 48 to 50% of new businesses fail within 5 years. Startups funded by family often do worse because investors are too afraid to ask the hard questions. Bailing people out can lead to resentment or enabling behavior. The fix? If you invest, only use an amount you are comfortable never seeing again, typically no more than 5 to 10% of your total investable assets. Starting out, it makes sense to trade time for money, but eventually the math flips. If a $5 million portfolio returns 5% annually, it generates $250,000 a year. That's $684 a day, whether you show up to an office or not. High earners often keep grinding 60 to 80-hour weeks, ignoring the compounding engine they built. The fix? Recognize that time eventually becomes your scarcer resource. No one on their deathbed regrets missing an extra hour at the desk. This final trap is psychological. People delay investing because they want to wait for the market to look less scary. But delaying a $10,000 investment from age 30 to 40 can cost you $74,000 in lost wealth. This also applies to debt. Refinancing a mortgage feels like a chore, but dropping a $400,000 mortgage from 7% to 5.5% could save $900 a month. The fix? Invest that savings. It could turn into over $500,000 over 20 years. Don't lose massive wealth just because a task felt cognitively unpleasant. Real wealth is lost in the quiet, in-between moments, slow accumulations of small, invisible choices. Generational wealth builders aren't necessarily smarter. They're just better at noticing these traps. Set up multiple bank accounts, automate your investing, and ask yourself right now, which of these traps is quietly running in your background today?